The next financial crisis could be on its way, according to authors of the new book, 13 Bankers, The Wall Street Takeover and the Next Financial Meltdown. Co-author James Kwak, who is also co-founder of the economic blog The Baseline Scenario, is here to discuss. How are you, James?
Good, thanks for having me.
Great. Well, I found this amazing because you start the book with Thomas Jefferson and Alexander Hamilton. And of course, context and historical context is so important. Tell me how those two figures can really help us understand the conflict between Wall Street and the government.
Sure. One of the central points we wanted to make in the book was that politics and economics are very closely intertwined, and that may seem obvious, but I think for the last 20 or 30 years we've been living with this idea that we have this apolitical ideal free market system. And when we started saying a little over a year ago that the background to the financial crisis, to understand the financial crisis you have to understand politics, that was somewhat controversial. And what we wanted to say was that this is actually not a new idea. So if you go back to Hamilton and Jefferson, Hamilton favored the first bank of the United States because he thought we needed strong, centralized financial institutions for economic development. And Jefferson opposed Hamilton not for economic reasons, but for political reasons. He was afraid that these centralized institutions would have too much political power because of their economic power. So we just wanted to show this is a debate that goes back a long way, and we've come out on different sides of this debate.
And so in turning to regulatory reform, sure, you have argued that really the most important thing that we can do is to not let these institutions get so big that they would take down the entire system. So how would that play out?
You know, we've been known for calling for large banks to be broken up, and we think that's for a couple of reasons. One is that it would solve this too big to fail problem. So the too big to fail problem is we have banks that are so large or so interconnected that were they to fail, it would cause systemic damage, like Lehman Brothers. And we think the simplest answer is just not to have these banks in the first place, so we think there should be size caps on banks.
So what are those limits?
Well, we call for, in the book, a limit of 4% of GDP is the maximum amount of assets that a financial institution could have. So that's about $600 billion in assets. By contrast, today we have 6 banks that are larger than that. Citigroup, Bank of America, JP Morgan Chase are all around the $2 trillion mark. So one way to look at this is we're saying that this proposal would only affect 6 banks, and we want to return them to the size they had in about the mid-1990s, when I think most people would say we had a vibrant financial sector that could meet the needs of our non-financial companies. And we think this is important for a couple of reasons. One is that it would help alleviate the problem of too big to fail. And then secondly, it would provide more competition. So again, instead of, right now there are five dealers that dominate most of the over-the-counter derivatives markets. If instead of 5 dealers you had 15 or 20, you would have more competition, which would be lower margins, better prices for customers, and so on.
Lehman Brothers or Bear Stearns, would they have fallen under the 600 billion cap or not?
So Lehman had about 700 billion in assets. Bear Stearns was about 400. We think that if you essentially if you risk adjusted Bear Stearns, they would have been over the cap.
So when you say risk adjusted, you're also saying that you want there to be some controls on the leverage, the amount of the bet that's being put on the table by the banks, right?
Sure, yes.
I want to talk a little bit about something that our producer noted in your book. She said that she was struck by the fact that there's no legislation that seeks to determine whether a given financial product is harmful to consumers. She extracted that nugget, and I thought that was really interesting. Does that argue for an Elizabeth Warren-esque, independent, totally, sort of on its own consumer protection agency?
So I think so, yes. I mean, the underlying problem is that for decades we have lived with this illusion that we don't need to worry about if products are harmful to consumers or not, because consumers can protect themselves. I mean, this is part of the free market fundamentalist ideology. And it ignores the fact that consumers don't have any bargaining power. Consumers don't understand the technical legalese that they get. And what Elizabeth Warren is calling for is she's calling for an independent agency that has the power to set rules that apply to all financial products. And some people say, well, existing regulators already had these powers. We don't need a new agency to do this. And in one sense, they're right. I mean, logically speaking, you don't have to have a new agency. But at the same time, if you look at the past 20 years, they didn't use these powers. The regulatory agencies we've gotten have failed. So I think Warren is right. We need a new one.
Double dip, yes or no? I told you I was going to give you one
Yeah.
yes or no question.
Yes. So if I had to say yes or no, I would say no. I think we're not going to have a steep fall off. I do think we're going to have a very sluggish recovery for both short-term and long-term reasons. Short-term reason being there are still other shoes to drop. So, for example, people have talked about the commercial real estate market for a long time. I don't think we'll have a plummet like we had with subprime a couple of years ago, but I think it's going to weigh on the banks, it's going to weigh on the economy. The longer term, I would say, the reason we're going to have a sluggish recovery is a lot of the growth of the 2000s was illusory. A lot of it was building houses and financing houses. And we need to find other sectors of the economy to pick up the slack. And I think that's going to take time. It's also going to mean that we'll need a financial system that knows how to allocate capital to the growth industries effectively, and I'm not convinced we have that financial system.
James, thank you so much for joining us today.
Thanks, it's been a pleasure.
And thanks for watching.